This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. That lovely week between Christmas and New Year's. That week of, I want to do something, but I don't feel like doing anything. You all know that feeling. But I still got to churn something out, even if it's a blast to my past, to give you one of those healthy kick in the butts as you start 2023. And of course, I can't do an episode like this without it being trend following. Let's jump right into two of my most recent episodes, not this year, but within the last couple years. Trend following specific. I'm sure when you reach back, just if it was a few years ago, you're going to find that timeless aspect of trend following. And when you're facing the shitstorm that you faced in 2022, the shitstorm that looks on deck for 2023, remember, there's people out there that knew before you knew. You just got to ask yourself, why did you not know? I hope you enjoy these two episodes. Wow, 1,000 episodes. I did not expect in 2012, and I can kind of remember starting this podcast in 2012, but I could never have imagined that I would get to 1,000 episodes. I'm one of the few people in the world where you can probably take my words, dump them into some kind of AI, and create an artificial intelligence Michael Covel right now. Take all my books, take this audio content, throw it into a blender, give me a new subject, and the AI Mike can probably keep going on forever. That's kind of fun. I think that's my goal now. But 1,000 episodes is a cool number. It gives me something to shoot for. 2,000 episodes. Now you might be thinking, who could I pick for episode 1,000? I can pick a lot of people. A lot of really smart, influential people in my life. But I started to think, what was the first trigger? The first trigger of my career. And that trigger was going to a Salomon Brothers interview in 1994. It didn't work out. Walking into a Borders bookshop, seeing Financial World's top 100 paid on Wall Street, and seeing a blurb in there about my guest today, Jerry Parker. And that just triggered me. That article, and I'm not going to quote it today, but that brief little paragraph said something like, Jerry was in Southern Virginia, he was using a trend tracking system, and he was trained. And that was the magic moment for me. I thought, well, I don't know this guy, Jerry Parker, but if he could get trained, why the hell can't I get trained? I just finished my MBA. I thought I had to know balance sheets and Warren Buffett and all that kind of stuff. But here in this one little magazine, one little article, this guy who lived 90 minutes from me, what did I do? I got in the car and I drove to his office. Guess what? He did not agree to meet with me. He did not agree to meet with me for 18 months. And finally, I sent him a fax. And the fax said something to the effect of the top 10 reasons you must meet with Mike Covel right now. A few minutes later, his assistant called me and said, you got 30 minutes on this date. I went down there, 1995, December, I believe, the first moment I met my guest today. That's really cool. That's fun because now he gives me the time of day today. I mean, I've tried to do a good job on my prior interviews with Jerry, but I'm very excited, as always, to bring on the most successful turtle trader. And if you don't know what a turtle trader is, you've got some kind of mental defect. Go figure it out. In all seriousness, my guest today is one of the legendary trend-following traders of the last 30, 40 years. What a great story. Today, I will take Jerry around all kinds of subject areas. There's no telling where we will go exactly. That's always the fun of a podcast. Just go off and see where you end up. Without any further delay, let's jump right into my 1000th podcast episode with Jerry Parker of Chesapeake Capital, one of the original Turtles, and definitely the most successful of the original Turtles. I hope you enjoy. In 1983, could you imagine having a conversation with 2021 Jerry and 1983 Jerry? What would that conversation be like?
It would pretty much be you're setting your sights too low. You never really know what's going to happen, especially if good things start to happen, incredibly good things. You could always just be so satisfied with what you know and what you expect. Life is always usually good, especially for spoiled Americans. Life is good wherever we are, whenever we are, we're happy. We got big plans, big expectations. But in my lifetime, your lifetime, one of the hallmarks has been it's really easy to exceed your expectations because of the way the world has evolved.
Well, let me keep you at that 2021 to 1983, Jerry, and even get more specific. You've now become Mr. Prolific on audio and video. When I first started chatting with you, probably in 2013 or so online, you had not been doing a lot of this at all, but now you're freaking doing as much as I am now, or maybe more. I don't know. But tell me about, though, more specifically, that 83 to 2021, I'm kind of noodling around the trend following world there because I guess in 82, 83, you had some inkling about trend following, but that was a pretty big turn, a pretty big change in early 84 for you. And you contrast it today. Do you ever think back to what a wild ride?
Yeah. From day one, I understood very clearly the opportunity that I had and we all had and how amazing it was, because that's the biggest takeaway from the Turtles is just we were taught by these genius traders who could have probably done very well and made a lot of money in a lot of different fields. We started at the very top from the best. We had a pretty good expectation of what we were learning and where this could take us. And then all of a sudden you start making 100% a year, 200% a year, but leaving there and starting your own business and the managed futures industry would expand and CTAs would start getting lots of assets under management. Yeah, that was all sort of brand new about how it was all going to happen, honestly.
Let me keep it at a thought about you, though. I know you are very humble about these kinds of questions. So, okay, look, it's a great story. I've written a book about it, The Turtle Experiment, The Turtle Story, and a lot of people did well for a long time. But I think you're going to win the endurance contest when it comes to the Turtles.
Well, part of winning it is wanting to be in the game, even after you've made enough money. And then the second part is sticking with the principles. And I think that that's where I definitely deserve first prize in that, because I did stick with the trend following principles. As I told you, one of the lessons I learned recently was that I think that my mentors were more interested and wedded to systematic trading rather than a trend following. It didn't have to be trend following for them, I don't think. All I did is I got experienced in the late 90s was just continue to trade longer term and extend my look back period and stick with the same strategy. Hardly no changes. I mean, I would do research and come up with changes that I would later say, oh, that wasn't a good change. I need to revert back and not add bells and whistles and unnecessary things to try to prevent drawdowns. I mean, that's where it all sort of comes in. You want to get rid of those drawdowns. But just sticking with those principles and just looking at the world in terms of trend following, everything is just through the lens of trend following. I would even ask some of the turtles, like, I'm going to start trading single stocks versus indices. Some of their responses would be, oh, that's great, because then you can add in some fundamentals or some other ways of looking at stocks and choosing stocks rather than trend following. And my response was, no way, I would never do that. So I just absolutely always refuse to give up on those bedrock principles that I learned in December of 1983.
What strikes me about you and maybe some of the distance between, look, it's a little unfair. It's like, okay, a small group of people, as you say, get taught by these genius traders. It's a great legendary story, but maybe some folks get unfairly positioned into slots. All that said, I've had a chance to know some of your peers and meet some, and I've often found that there were many, and some are no longer with us, that were highly emotional. And I find what's interesting when you talk about trend following is you're kind of talking like a Zen master almost. You're very Zen about it. And I think maybe even though people, and you can correct me if I'm wrong, even though people could execute under the tutelage of Rich and Bill, that maybe when they're out on their own, they didn't really grasp completely. And I think you just said that a second ago. They didn't truly grasp what you just described, the emotional part, the living with it part.
Well, I think that you can definitely dig deep into this topic. It can be explained very simply. And I have children who want to trade, and they're all in their 20s and 30s, but let's say they want to trade, and maybe they're not the most skilled in math, or they're just preoccupied with other things. That I can teach them, buy here, buy this breakout, sell that breakout. And I think that to some degree, if they don't dig any deeper and understand even the math of it at all, they could probably make a nice living. You don't have to really get into it very much. And in some ways, if you don't dig too deep and you're kind of preoccupied with skiing or snowboarding or other things, I'll do my trades in the morning and then I'll go out and have my fun, then you maybe not be tempted as much to try to change it. For me, there is a lot of depth to it. And it was just like I was uncovering what it really meant and what the principles meant, especially as you apply them and you get faced with opportunities to not apply them. I've found that a lifetime spent refining your trend following is a perfectly great use of your time. Other CTAs who sort of said, okay, I got the trend following nailed, I'll add mean reversion, or I'll add pattern recognition, carry trade, and all these other things to it, as if, well, the trend is done. I know how to calculate a moving average, so I'm done with that. I felt like, no, that's not exactly true. You can dive deep into this and at least learn a lot about what works and what doesn't work.
The last year and a half, a really stellar trend following period. I know we kind of exchanged some emails. I had Don on from Purple Valley down there in Florida. For a long stretch there, we had a lot of people saying, you've seen this more than I, the trend following is dead meme. And all of a sudden, even you had some great trend following traders that we both respect who were saying there was a problem with trend following. And then all of a sudden, a guy like Jerry Parker, who sticks to his knitting, but I know you're not running around trying to say to people, I told you so, I told you so, maybe a little bit, but you did tell people so.
Well, one of the big lessons since last fall, since it's been such a great move in so many of these markets, currencies, commodities, grains and metals, base metals, Bitcoin, lumber, some of these really stand out. Tesla, I was lucky enough to have Tesla in my portfolio. I think the big lesson, though, is it wasn't our fault. I think it could have been our fault to choose trend following. You cannot rely upon a method that has 5% of the trades are going to make all of your profit. And you've got all this diversification. You need to figure out when the commodities are not going to work and it's just load up in stocks and bonds. So that could have been a mistake to choose trend following and to choose diversification. I don't believe that. I believe in looking at all the data, not just recent data, and following the rules and not trying to figure out which regime we're in and burden your system and pollute your performance and your results with extraneous matters. The big lesson we learned is it wasn't our fault because we didn't have big outlier trades. And so we weren't doing anything wrong. Once again, apart from we shouldn't have chose trend following to begin with, possibly. Now we're all sort of humbled by what really pays the bills is these amazing trends that our main job during these trends is not to do anything. We bought the breakouts in October, November. The markets started skyrocketing. And as long as you didn't apply some sort of vol target or profit objective and just waited for your retracement and your trailing stop to be hit, which a lot of them haven't been hit yet, then you're going to do very well. And I think that's sort of the lesson is sell your soul, sell out for the outlier, whatever it takes. That Tesla trade, it went up a lot initially. 50 ATRs. It retraced 49, and now it went up 400. Depending upon your look back period, you could have definitely gotten out a few times if you're looking at the 50-day low or the 75-day low or whatever, which is fine. But if you have some longer term stuff, that painful drawdown is just the price you pay for hundreds and hundreds more ATR profits. It just takes guts to do that and not to pick up the phone or pick up your laptop and dial in and take some profits.
Let me keep you at a point that I did not follow up on when you were addressing that your two mentors early on, Rich Dennis and Bill Eckhart, that you would classify them as systematic traders, not necessarily trend following traders. But if I was to pick a little bit there, I would classify you as a systematic trend following trader, would I not?
Oh, definitely.
Why don't I let you explain what you meant by them being systematic and not necessarily trend following?
At some point in time, like let's say the late 90s, the trend following, the shorter term stuff that we use as the turtles, that didn't work very well and hasn't worked well since. So my simple idea was, well, let's just see how, if the 20-day low doesn't work, how does the 120-day low work? And just keep expanding your look back period so you won't get chopped up and whipsawed out of these large trends, with the cost being that when you do have the big trends, your trading stop is going to be far away and you're going to have a bigger drawdown. That's pretty easy, and I think unacceptable for people who say, hey, that doesn't feel like a good return risk trade-off there. I'd rather look at something with a shorter time span, keep that 2 or 3 week look back. Your typical outlier might be 20 ATRs versus my typical outlier might be over 100 ATRs. And so I think that's probably what they were more committed to is, well, it may not look like trend following that we taught the turtles, but it will be systematic, rules-based, back-tested, and things like that. I think from day one of the turtles, it was pretty well known that Rich and Bill were skeptical about the future of trend following and the parameters and the way that they were teaching us. It was like, this may not keep working very long. And so I was like, what am I doing here? And so like before the turtle class was over, it was like a pessimism about how long this was going to last and work. So I think having that in your mind, that you need to always be worried about that, sort of trying to evolve away from parameter sets that are too enticing for other people, is a good mentality to have. And I've just settled it all by being so long-term and so willing to take ridiculously large drawdowns on profitable trades that I guess my assumption is it's not going to attract very many other smart people.
The principal part of what you just described, even if the parameter sets change, and you've already said this, going for the 5% outliers and whatnot, but the principles, why do the principles stay? Why, for example, long time ago, two really smart, legendary traders were pessimistic. And okay, maybe by somewhat luck, I don't know, but okay, one of their students said, well, this long-term stuff, I think there's something here. And now we roll forward multiple decades ahead. A lot of people that were around back in the day, older traders than you, they're no longer with us. So I guess the real question is something like trend following as you describe it, that 5% of outliers. And with generations, at least until we get life extension, generations always coming and going, it sure seems like if somebody can live the Jerry Parker portfolio and live the Jerry Parker strategy, they might be okay.
Oh, definitely. I think one of the things that happened over the years was trend following started to change from what I would call the sort of the classic trend following, one entry rule, one breakout entry, a breakout exit, and a stop loss. As far as the signals go, can't hardly beat that too much. Maybe you can throw in one other thing on the entry side. It started to change from let your profits run to what's the sharp. And we need to be very concerned with these return, our performance, daily performance, weekly performance, monthly performance, rates of returns. And I think that it's hard to let your profits run if you're going to be concerned about your volatility of your returns. We've got the risk covered. We're taking these small losses. That seemingly is great. That's our money management. We diversify like crazy. We do longs and shorts, and then we take small losses. But then it was almost like what really changed was we need to pay attention to our volatility of our profitable trades. And if it's a drawdown on a profitable trade, they've been redefined as losses. what? How does this happen? So just me rejecting that idea, I mean, there's no way to accept that and keep my philosophical head straight that you got to let your profits run. And profitable trades, you can lose hundreds and hundreds of basis points. Losing trades, 50 basis points, 25 basis points max. So this was, I think, the big change, and one that impacted and affected everyone, almost to a person, except a very small group of people like myself who refused to give in to this sharp and vol targeting.
I'm not sure if you're hinting at or saying it, but we had kind of talked a little bit in advance, and you mentioned the European trend following traders or European CTAs, and I'll let you define what you mean by that so people don't think it's necessarily a pejorative. You talk about European CTAs having trend following plus other stuff. The other stuff, like trend following's not good enough. You got to add the other stuff. I think that's really what you're getting at, is that a lot of big name traders, people that I respect, people that you respect, did add a lot of stuff, and some of that's not worked out exactly right.
There's at least two kinds of stuff. One is the ideas that I mentioned before: pattern recognition, carry trade, short term, mean reversion, now maybe AI and machine learning and things like that to improve your trend following portfolio. Managed futures is maybe one of the few hedge fund categories, if it is a hedge fund category, that it's not good enough to allow allocators to allocate to pure trend. You need to create sort of a portfolio of strategies yourself in order to get assets. So that I never was really interested in. But I think that's the least offensive of the other stuff, which the stuff that's more offensive is the vol targeting and the paying attention to sharp. And trend following is the one idea that sharp has no place. Upside risk, downside, I don't know what you call it. It's ridiculous. You're letting those profits run, they're profits, and your risk is these losing trades and how much you're risking per trade. And this is what I didn't like. And then these guys from the European CTAs that really hit it big, they were really great at building these great businesses. Hats off to the business aspect and getting the AUM. I think they kind of figured out that, well, if you want to have these big businesses and make a lot of money managing other people's money, you're going to have to take as much of the trend stuff as people can handle and maybe add in, well, we have these PhDs, we're going to manage the volatility more. We are going to pay attention to sharp. No one asked them to do that. No client was saying do that. It's sort of a marketing thing or business thing where you can say, hey, you can stick around with these traditional trend followers with this big volatility, or we'll manage all of this for you into something that's a little bit more palatable and more scientific with all of our PhDs in different commitment to this traditional way of looking at markets, which is sharp and volatility of returns. And it wouldn't have bothered me so much, of course. It's a great business opportunity to say, hey, I'll allocate to those guys and I'll allocate to people who do it a different way. And when I would go in and talk to clients or potential clients, I would actually say that we're one of the few CTAs that doesn't vol target, and we just let the profits run, and we trade single stocks and things like that. So you need to have both in your portfolio. But I guess some of them just could not resist trashing the turtles and sort of trying to build up a legacy of, well, when we got on the scene, we made things a little bit more scientific. And they would call themselves scientists as well, which I guess is okay. I would be a little embarrassed, even if I deserve to be one, to call my trading science. But I think that that's what got me going, was the trashing of the turtles and sort of a simple way of doing things. And now watch us, we're taking it to a new level where in the long run, I knew it was not going to succeed better than a classic approach.
I think what you're really getting at is got to be something really tough for investors. I don't know if I should say allocators, maybe allocators to some degree, but for investors is to really dig through the weeds to find those base principles and to understand the base principles, and then to understand when someone or some group is doing what you are describing, the marketing, to be able to decipher that. I mean, you've got a hell of a lot of experience to decipher it. I've got a little bit of experience to decipher it. But I think for the average person, the glossy write-ups and all that kind of stuff, it sways people. And it is a very At its root, I think to understand what a Jerry Parker does, you've got to really get the philosophy first. To me, it seems it starts with the philosophy. What are the principles? Then you can get to the rules, then you can get to the execution. But someone's got to truly understand what you said at the beginning of this podcast is about the 5% outlier trades. And that's tough, I think, for a lot of people to understand when there's so many other people out there yelling and screaming about they've got the next new thing.
Their performance was great. I think there can be periods of time where, sort of, in my opinion, doing the wrong thing and having suboptimal strategy can do very well. And especially if you have short-lived trends. There's been many trades over the years where I remember cotton would rally and it would make 15 or 20 ATRs and I would lose it all back. It would just crash the next week. And if you have what I would consider not a great strategy, but that takes some of those profits, you can have what looks like a better strategy. Just clients are weak and they want to buy into it. If you tell them and you can convince them that you can have what you want and I can minimize the negativity, they're all over it. No one wants to hear like eat more broccoli. And that's pretty much what we were saying the whole time. And their performance was better. And then I think coming out of two different camps, I'll never convince anyone, none of those people, that Richard Dennis and Bill Eckhart gave us far superior systems and philosophy, but it's absolutely true. That's where we came from, which was basically trade for yourself. Maybe you'll have a few clients, but have a chip on your shoulder. Clients will always be tempting you to do the wrong thing. They don't understand. And the whole basis of what you do is it's hard to do and it's counterintuitive. And letting profits run and accepting volatility is difficult. You need to be aware that whatever lurks out there is not going to brag on you and compliment your trading strategy. It's just going to make the most amount of money and be the most robust. The other guys, they were coming out of these big trading firms that had marketing departments and were raising lots of assets and with probably a minimum emphasis of research or trend following in general, moving average crossovers and things like that. And then we're kind of done. Now, how do we put together this organization? What is it going to look like that will attract people to give us lots of money? And so A+ for them on that. And that's why they have these big organizations and they're so much better at raising assets, because that was their main goal, was to raise those assets.
It's an important distinction for people to try to understand. Difficult, never easy. Let me shift you to something though. I've been through your Twitter feed recently, and for people out there that have not seen Jerry's Twitter feed, if you don't want to do all kinds of interesting research to find confirmation and backing to the philosophies that Jerry's talking about, he finds it and puts it on his Twitter feed. So I feel like I don't even have to think. I can just go there and it's always there. And you had one, I want to read this and I'll let you comment on it. I think you're quoting from somebody else, but it said the big blowups are typically caused by extreme intelligence that causes people to believe their own dangerous stories that you can predict with accuracy, use leverage because your prediction must be true. I'll let you comment on that, but I think also it would be interesting too is your thought that given to where we are right now with many markets extended, especially U.S. equities, there's probably a few of those lurking out there that could get pierced sometime in the future. They're doing exactly what you're describing, but the leverage is being hidden inside of bull markets.
Yeah, that's a really good quote. I should have mentioned something about that because you asked me a question earlier. And really, I think what gets at the heart of that is how, for some people, trend following is so hard because you can add things to it. That makes it so great because it has that one rule entry, one exit rule, one stop loss, and then we're done. And I'm saying you're done. And I'm sorry, but you're going to have some drawdowns from your open trades that are going to make you uncomfortable because we like that money. It's our money. We've already spent it. They even call a drawdown in an open trade a loss now. You take these smart guys with PhDs and you tell them, okay, you're finished. Now go market or something. Like, no, I don't want to be finished. I can always improve and I need to get rid of these. This is what's standing out are these volatile periods. And so it's just very difficult for really smart people to say enough is enough and I can improve upon this and just fall in love with this back test. I mean, I think that's the worst thing going is the back test. I like to look at the trade stats, the average win, the average loss, the win percentage, win-loss ratio, and things like that. People tend to fall in love with the equity curve back test, going back to the 70s and 80s and watching how the markets go up and down and really take away some key clues from all of that, which I don't think there are any clues at all. It's to be ignored pretty much, except that if you're picking up on any risk in the future that you've seen in the past, just pretty much bank on that it's going to look worse in the future. And in some of these firms would really make a big emphasis on research and change and evolving, because this is what clients want to hear. But true trend following is we don't change. This is our problem, is that we're always in constant search for more and more sample size. We must include the 80s and the 90s in our trade stats. And the world has changed a lot since the 80s and 90s. Is it still okay to use all of those trades? This really baffles people and makes people very nervous to not evolve and change over time. A lot of the industry, that's their main calling card. Watch us do our research and watch us evolve and change. And that goes against classic trend following.
Well, classic trend following is taking advantage of classic human nature, which doesn't seem to change, does it?
I don't think so. And it's looking back over all of that period of time and seeing that you have these outlier trades and you're going to have this volatility, and it's fine. It's not good enough for a lot of people for the computer to say to you, hey, if you risk 50 basis points per trade, these parameters are going to make the most amount of money for you. It's not good enough. Well, I need to eliminate some of those bad days and months because I'll be getting phone calls and complaints. Deep down, I think it bothers them just as much as it does the clients. They actually believe that targeting volatility and having special rules, special profits is something that they should do and want to do.
I want to keep it at you for a moment. Obviously, I think anybody that has heard you before or seen you talk, they probably think to themselves, it seems like a pretty disciplined guy. And I know you're very conscious of health, fitness, your weight, and you have been for a long time. When you speak to your kids and they want to kind of learn about your routines and your habits, how are you talking to them? I mean, I'm really curious about the Jerry Parker discipline, the Jerry Parker ethos, because you probably did not have the same ethos about physical fitness and staying in a certain way. You probably did not have that when you were younger. What has allowed you, and speak to this process of developing you?
I think practice comes to mind. That's what the secret is. We all kind of realize that you can practice piano or your basketball, but all of these disciplines can be practiced as well. I remember when I decided to get in shape, I was 40, and I had never been in shape a day of my life. And so I had no expectation, but I just started to realize that day after day, putting one foot in front of the other, you get better. You practice and you learn and you sort of figure out things that you thought were impossible are not impossible. It just gets better and easier every day. And that's that discipline. And then I was highly motivated by results. Once I started seeing results in trading or in diet and fitness, I ramped it up. I went extreme. You can even hear everything I talk about. I want to try to make it as pure and extreme as possible and kind of get to the core principle and be the one person who may be able to take it further and more in depth than maybe I should, but at least talk about it in those terms and try to see if you can't push the limits as much as possible. When you first start out, you're not thinking about anything except let's lose 5 pounds. And then as it starts coming off, I was just getting more and more excited and going, okay, we got to go for high school weight. And so I had never lost 5 pounds or 10 pounds in my life. But as you start seeing success in implementing principles and understanding the principles of what works and doesn't work, you need to start pushing yourself to extremes that you never thought you should even imagine. And so I think that's what I'm good. I can get obsessed with things very quickly, trading, diet, and fitness, but then understanding the basics, learning over time, and listening to other people and saying, okay, this is something I haven't heard before. It doesn't sound like it fits with my philosophy, but I'm going to think about this and keep it on my list of things to explore. And then maybe I'll get rid of it later or I'll incorporate it into my plan. I just feel like I was incredibly open-minded about anything people would tell me about trading or diet and fitness or any area I was interested in. I was just totally open. That's rare these days. Rich said many times that I think I could print my rules on the front page of the paper and no one would follow them. And I think he meant they were too hard to follow. Small losses, 40% win rate, let your profits run. But I think now I could print my rules on the front of the paper and everyone would just criticize them. They're too simple. You don't know what you're talking about. I studied this in college and you're not using Sharp. So I think that's the new way of looking at mentors and older people who've learned a lot, is to argue with them and disagree with them. That's fine. I don't really care. I love a good argument. I try to foment arguments all the time on Twitter and get someone criticizing my views so I can kind of learn and hone my responses.
Interesting about what you said about the practice and the experience of it. Okay, you don't know anything about fitness, you're age 40, you start to lose the weight, it comes off, and then some kind of like magical motivation happens because now you are personally experiencing it. That is very difficult to share with other people because it's the magic of experiencing it yourself. And then all of a sudden it's like, wham, bam, thank you, man. It just feels so good and you can believe in it, but it's tough to share with other people, isn't it?
It's tough. I don't think I've had very many friends or family come up to me and say, tell me your secrets. I have had people come up to me and say, write down what you did. What do you do? And I could do that in trading as well. Write down all the things you do in trading or diet and fitness or whatever. And I did that once and I looked at the list and I was just shaking my head because it's not something you want to read up front. You want to take these baby steps and figure it out for yourself. I just had a really nasty competitive streak that I could tap into once I got a glimpse of some sort of accomplishments that I had never thought was possible. It was the same thing with the turtles. I remember being obsessed with getting to 100 million. My friends were like, what's wrong with you? Why can't you just calm down and settle down? I'm like, no, 100 million. I got to get to 100 million. And so I was just extremely competitive and not happy if I was in second place or worse than second place, as far as returns or relative return. So I was really a bad loser. Oh, I'm a hugely bad loser.
Right when you said the phrase nasty competitive streak, I thought you were going to pause. And the next thing that was going to come out of my mouth was to ask you, because I could feel like the symbol shot right there. I just wanted to say, why are you so competitive? What made you so competitive? Like before you said it, I was like, oh, damn, he stole my thunder.
Oh, man, I don't know what made me so competitive. Someone asked me on Twitter yesterday, did it come easy for you to be disciplined? And I said, no, it did not. And from day one with the turtles, I was probably the least disciplined. But in my interview with Rich, I was like, oh, I'm incredibly disciplined. Oh, yeah, we're all disciplined. We can all talk about how disciplined we will be. Right out of the gate, I was probably the least disciplined of all the turtles, January 1984. But thankfully, I seldom got rewarded for my lack of discipline. So I was always chastised all the time, day after day. If I didn't follow my rules or my system, I could immediately almost see the downside of not following it. So I had no positive feedback. So I righted myself very quickly over the years to be better disciplined. But honestly, the amount of money that I've left on the table by not being 100% disciplined or even close to it is pretty sad. It's a sad story. We don't need to get into that.
You brought up crypto earlier. Now, for some people, the uninitiated, and I don't know what percentage of my audience is uninitiated. I go all over the rainbow in terms of topics, but you brought up crypto. And of course, if someone, and hopefully they do know about trend following, but trend following traders would know, okay, crypto, it's another market. Jerry can trade, Mike can trade, anybody can trade. And okay, Jerry's going to apply trend following principles to it. Speak to crypto. How did you make the decision? When did you make the decision that, okay, this passed the smell test for me, I'm in? And I'll let you also comment on crypto itself, because a lot of people are going to be thinking, when I'm asking you about crypto and when you're responding, that Jerry must be a crypto maven. You might be, but that really doesn't have anything to do with your trend following trading.
That's right. I mean, that's 100% right. The answer to that question is always the same for every market, any market, and that is liquidity and diversification. So obviously, it's pretty diversified. No one even understands it. I have people tell me about it, and I still don't understand it. So then that makes it less susceptible to deviating from a rules-based system. So I think to some degree, it's the perfect market for trend followers. You have no clue what you should do other than following your system. Unlike all the other markets where we sort of do have a clue, we think we have a clue. But I think what happened with Bitcoin, I wasn't alone in this, is that all of us older guys who were looking at it and trying not to be left behind, and having been burned so many times for being too skeptical about new ideas. We didn't know how to open up a Coinbase account. And then, oh my gosh, all of a sudden the CME comes up with the futures. Yes, I know how to trade futures. I have a lot of them in my account right now. I know where the CME is, and I can put this thing on. I think that's probably one of the reasons that the cash futures spread got out of whack, was because all the hedge funds and old guys like me were only interested in doing the futures, and we didn't even know how to set up our Coinbase. I'm skeptical of Bitcoin in a sense that I think it could be a little dangerous in these crazy sell-offs. I'm not happy with that. It doesn't look like something too different from all the other markets I trade, because there's been crazy sell-offs in everything, lumber and some of the stocks even. I've been around a long time, and I've seen crazy volatility in the bonds and the British pound, for God's sake. So don't talk to me about crazy Bitcoin. It doesn't look any different, really. But I do wonder what's going to happen in the long term, because I'm really always interested in being able to exit the trade. But I probably shouldn't be, but it's definitely in my portfolio. And that's another great thing about the markets since the 80s, is the number of markets that are out there. My portfolio is so large now, over 100 markets. And so that makes me very happy, and I can take a lot of small risks in a lot of different markets, Bitcoin being one of them. And Ether pretty soon, I think. There's the futures on that. And my friends tell me it's different and it's not 100% correlated to Bitcoin. So I'll probably be adding that as well.
It is a little unusual in the sense that, at least when you started, okay, a lot of futures contracts on ags and metals and then currencies and stuff like that. I mean, Bitcoin could literally be a great trading opportunity. I'm not saying it is, but it could end up just being a scam. I mean, literally, there has to be one option on the table that it's a scam, but a scam that is got a ton of money in it and is very liquid and goes up and down and is legally traded on an exchange and is generally accepted by the public. That's okay.
Yeah, I mean, anything's possible. I definitely read a lot about it and listen to a lot of podcasts. I know it's not a currency, so that I don't care about. I'm not sure what it is. I do have sympathy for people who, like people in certain countries like Venezuela, who, if they could have put their money in Bitcoin 20, 15 years ago, their life would be a lot better. So I do think that it is a great fail-safe for crazy governments and fiat in extreme situations. But it's definitely has its own personality. It's not gold. It's not a currency. It doesn't need to be to have value. And I do think it has this. I grew up in the 70s with Milton Friedman and monetarists and printing money, none of which matters anymore, I guess, or yet. But having that algorithm with a fixed amount of Bitcoin, that is pretty funny. It's pretty appealing for a kid from the 70s, because that's what we were taught creates massive inflation, is the ability to just keep printing and printing. So I hope it stays alive. I hope it does well. And I hope it expands into more and more diverse cryptos that are complement, so we can have a fifth: currencies, commodities, stocks, bonds, crypto, 20 cryptos. That would be fun.
Speaking of extreme markets, I want to quote one more, maybe two more from your Twitter feed. And again, I think this is you quoting somebody else, I believe. But the quote was, even if markets are in a bubble, your position should be long until your trend following exit is hit. That's all there is. That's the rule. Nobody knows what the markets will do and where prices will be tomorrow, next week, next month, or next year. That is a really tough thing for people to handle, that they might have, again, you spoke to the extreme intelligence. They might have this extreme intelligence and they have decided we are in a massive bubble situation in XYZ equities or whatnot. And they want to apply all that intelligence. But that's not the way it works. There's always going to be a person after the fact. And I'm not criticizing Michael Burry. He's a very smart guy. I love the movie. But there's always going to be somebody after a bubble bursts that's going to be there and be that person that predicted it perfectly. You can't really build a life and a trading strategy around trying to predict the one bubble that's going to happen in your lifetime.
It's almost like if you do that, it was such a rare thing and you may have been lucky, that you should just walk away. I think some of those guys, some famous ones, they made a lot of money in that period, and then they ended up starting hedge funds. And from then on, the hedge funds just lost money. Maybe all you have in you is that one big trade. I think we have a bubble in bubbles. That's another quote from someone else. I may have made all my life's fortune in bubbles. And so what? I mean, who cares? The market goes further than it should. It's crazy. And we rode the trend up. I mean, maybe that's why trend following works. That's fine with me. That quote is from my two friends, Moritz and Moritz. I think that the big issue with that is something I've learned over time. And that is you can't predict the markets. Not only that, but today's market has no bearing on tomorrow's. I've been in so many situations where the market closed on its high. It made an all-time high. I was making a ton of money. It closed on its high on Friday. And man, the weekend was just so much fun. I felt so awesome about myself. I'm at equity highs, this group of markets that closed on their high. It was a strong close. And of course, that was the high. And it crashed from there. And vice versa. I limit up one day, it can be limit down the next day. You think you see these patterns and you think that it's so obvious. I cannot believe I'm waiting to the 100-day low to get out of this thing. It's so dumb. Why am I doing this? All my friends are taking profits. And then all of a sudden, the market reverses and goes back up. It's just in the cards that that has to happen. To have a two-way market, to have a life where we all know prediction is impossible, you are going to win on some of those situations by just following your strategy. And you're going to win overall. If it wasn't the right thing to do, the computer would tell you, don't wait until that 100-day low or that 200-day low. But you get enough of those reversals where it keeps going and makes new highs. So I think that's the lesson. Put your trades in the morning and then don't look at them until the close.
I love what you just said about making money in bubbles. What a great quote. We need t-shirts about this. The Jerry Parker t-shirt. So what? Who cares? Like, listen, you could write a book. If you could write a book explaining the depth behind the statement, so what? Who cares? Really? I mean, you know that. You know what I'm driving on there. There's a lot of depth behind that. Most people say, oh, that's just a throwaway from Jerry. Your voice was going down. It's not even that big deal. So what? Who cares? Is a huge, huge philosophical point.
It's so funny to read what other people write about bubbles and the extended stock market. And they're so uptight about it. And they've been doing it for so many years. And have been wrong for so long. And I just sit back in my little bubble and just trend follow. And I don't really pay much attention to any of a reality. It's just what gets other people so upset and so uptight. And their idea that this is what I need to unlock. I need to unlock the secret of these bubbles. But I think when I was in my 20s, I was like, I need to unlock the secret of staying on these trends. And it just came to me that that was what I should be really concerned with, is capturing these outliers and not giving a twit about why and why they were outliers. And is it a legitimate outlier? Is it a legitimate move? I mean, to me, it's just such a waste of time. But to a lot of people, it means a great deal to them. But I don't really understand. I guess I've been a trend follower and a trend follower at heart before I learned about trend following. Yeah, that's definitely true. I definitely believed it before I knew anything about it. I was fertile soil for this incredibly magical experience that we had, the Wall Street Journal ad, and then going to Chicago and learning. I'm in my 60s, and so my memory is not as good as it used to be, but I do have a photographic memory when it comes to things that Rich and Bill said to me and said to the turtles.
By the way, I think we've talked about this before, and I'm in the process of pulling it together, but I will share a copy with you when I've got it all pulled together. I probably single-handedly have got every last thing that was ever printed or quoted about that entire Wall Street history of the turtle. I'll have to share that with you one day when I've got somebody working on it now. Who do you enjoy the most on Twitter? Do you have a couple names you want to throw out that you really like? I'm already telling people they should go follow you and check you out, but who do you really enjoy on Twitter?
Well, I enjoy Moritz Seibert and his buddy Moritz Hayden, I think, and two quants. And then I enjoy Niels. Richard Brennan is really good. Morgan Housel, I quote a lot. Mark R. from John Henry, ex-John Henry.
Oh, I'm not going to let you get away with that. I'm not going to let you get away with it. You got to say it.
Mark Rozemski. I don't know how to pronounce his name. Rob Carver. I have a lot of loyal Twitter followers and Clubhouse. I'm on Clubhouse a lot now. I get a lot from those guys as much as they get from me. And like you said, I'm just pretty much searching for something out there in the news or study that I can twist into something that benefits trend following and putting that out there and quoting other people. One thing I did want to go back to that I keep forgetting I wanted to mention, I think this is worthwhile, is that I think that it would have been a much different experience for the Turtles if we would have stayed working for Rich a lot longer. In hindsight, the mentorship that we got was so important. It was more than just the rules. I've sort of used this bad analogy of here's a manual, now become a Marine. It's not possible. I mean, the manual is necessary, but you're not going to become a Marine without the boot camp. Here's the list of rules for the Turtles, but getting that list from Rich and Bill and having those 4 years is indispensable. And another 4 years or 5 or 10 years would have been so much better. And I think that the legacy of the Turtles would have just benefited so much in terms of trading and discipline and business. And so I think that that is something that is not to be dismissed, is that we would have been much better at our job if we'd had more time with those guys. The time that we had was indispensable for our success, not just the rules. And that's just maybe coming over and talking to us like once a month or less, but just knowing that they had your back. Navigating the markets in the 80s and the 90s with those guys would have just been a big benefit for us, for sure.
Can I push back just a second? I've already kind of laid you out as the guy that's got the endurance, the guy that's kind of like stood the test of the time from the Turtle experience. But I think there would definitely be some people in the class with you, the two classes, that maybe they did really well under Rich and Bill's tutelage, but maybe they weren't cut out for it necessarily? Or do you think that if everybody would have stayed much longer, as you just theorized, that that would have helped some people that just needed more time?
Yeah, possibly. Like I said, I think going through the markets and just living with the trades and the trends and the losses, we had 4 pretty darn good years where we made a lot of money. So going through some of those bad years and maybe a losing year or two with those guys and spending more time, maybe changing the environment a little bit, like everyone leaving the office and working from home, or Virginia and Florida and New York, and then coming back together once a quarter for an update and that sort of thing. Maybe that would have been good. I think the environment, everyone being in the same room, that had not always a hugely positive impact on people's trading and their creativity. Rich wanted some creativity from the group, and I don't think he got very much creativity and new ideas. So it could have changed a bit. Going through the tough periods with those guys, I think would have helped everyone.
Will your football team get another one this year?
Tampa is really having some good fortune. And at some point, I felt like you had to make a choice between Brady or Belichick. And I chose Belichick. Brady will be nothing without Belichick. I remember going to the Super Bowl and sitting down and going, whoa, wait a second. If he wins this thing, this is amazing. I'll never bet against the GOAT and Tom Brady. It's so much fun to be in Tampa with the Lightning and the Rays and the Buccaneers. It's a magical time. It's a great place to live. I just love sports. Do you get to see any NFL?
Yeah, I catch up. I tell you though, I think with Brady, it's going to take a handful of years before we all appreciate how crazy it was to leave New England, go to Tampa, and pull it off in your first year. I just don't think that story gets enough credit as to how amazing from a sports perspective that is. It's just truly, it's one of a kind. I mean, that's not going to be repeated. Nothing like that. He might repeat it. He might do it again, but no one else is going to match him.
Yeah, no, he's an amazing person. No doubt about it. He's easy to root for, especially if you live in Tampa. I'm a big fan of reading books, studying successful people. And I think he's a guy who obviously has a process, and he talks about his process of being in shape and leaving nothing uncovered, paying attention to the smallest details. So he's a guy who would probably fit in with trend following, because I think he loves the process, wedding himself to some basic time-tested philosophies like I do.
Jerry, everybody can find you easily on Twitter. It's always curious to me that when I want to pull your Twitter up, if I go to Google, it must be a very rare name, because if I type in Jerry Parker, you always come up 1, 2, or 3. Even though it seems like a very kind of name that's very common, Jerry Parker is very unique. It really is. It always pops up. You don't even have to give your Twitter handle. If you just type in Jerry Parker, you're going to find you on Google really fast. Is there a website you want to send people to, Jerry? And also, you mentioned Clubhouse. Is that a private thing that you've got, or is it only by invite right now?
No. Clubhouse is open. We have 2,000 members. Trend Following Trading Club. I would say probably half of those are from India for some reason. So Indians, I think, like trend following and process and systematic trading, it seems like. Clubhouse is a great venue to talk about trend following trading, and ChesapeakeCapital.com, and Twitter is great.
I saw the Indian switch in my world just in the last 3 or 4 years. All of a sudden, just India's like online, into trend following, wham. Good insights. Jerry, I appreciate it. Hopefully we can talk again in the future. So far, you keep talking to me. I guess I've not done anything too wrong yet.
I really enjoy you, and I appreciate all that you've done and all your research and all your archives. And I would love to get my hands on some of those things and see this new book or project you're involved in with the turtles. So thanks for all you've done for us. And likewise, whenever I type in trend following, you come up. So that's a good thing.
Yeah, they had to change all the names of the strategy to something else, because if they kept with trend following, they were just helping me.
Thanks for having me. It's been fun.
Hey, Jerry. Thanks, man. I appreciate it.
Enjoyed it.
My guest today is Russell Corgown-Carr. He is the CIO of Man AHL. For those of you that want to quickly find out about Man, and this is not a promo, but just if you're not familiar with Man, go to man.com. And also, for those of you that don't know, Man is one of the pioneering trend-following funds, firms, however you want to call them. Russell is kind enough to follow my stream of consciousness today, my taking him all around the trend following and trading worlds. We cover all kinds of territory. I hope you enjoy. Without any further delay, let's jump right in with my guest today, Russell Corgown-Carr. I want to know, I don't know if you can give me a month. I know you can give me a year, I think. When is the first moment that you maybe not understood trend following, but the first moment that you understood about it or you became aware of it? 20 plus years ago?
I became aware of it 20 years ago, but when I started my career, so I studied physics in university, and I really didn't know what I wanted to do. I kind of fell into this job doing quantitative trading and kind of coding these trading strategies. I must admit, when I started, I was a cynic.
But hold on. I'm not going to let you go that far. I want to really get this down to a granular level. Where were you? How old were you? Like, what was going on when you first had this moment that you came in contact with this world, so to speak?
Well, that was after university. I knew very, very little about it when I was ensconced in my world of studying physics. I guess I was about 22.
Was your first job with Man?
It was my first job. It was my first job. And I, at the time, I knew so little about it. They looked at my CV and they said, look, you've obviously got half a brain, but do you know how to code? And I said, no, not really. They said, well, you've got 2 weeks to learn. So I went off and learned as best I could, and obviously did a good enough job after 2 weeks that they kept me. And I'm still here.
How did you even find yourself at that interview? How did that unfold? You just said you basically were not aware of these things. How did you find yourself at that interview?
Funnily enough, I finished my degree and it went well, probably better than I expected. So I thought, well, maybe I should be doing a PhD in physics. And I went to meet several professors, and they all worked in these underground basements. I thought, I can't do another 3 years of this. I need to get out into the world. I really didn't know what I was going to do. So I had to earn some money. So I went around doing these kind of temporary jobs, which are very basic, very kind of trivial jobs. One of them was in the Treasury Department of Man Group. And she looked at my CV. She said, what the heck? What are you doing? Go and speak to these guys downstairs, 1 floor below us. They're all these science guys. I don't really know what they're doing, but go and speak to them. And I think you're very well suited to that kind of job. And that was it.
So hold on. You were doing essentially kind of temp work. You had a pretty impressive resume. So you're doing temp work, and somebody at Man realizes that you might be a little more qualified to be doing something a little bit more than what you were doing.
That's exactly it. And at that point, I was figuring out what I wanted to do, and I really didn't know. So one thing has kind of led to another.
Okay, before you came to Man, you weren't like trading your own account or trying strategies or anything like that. You came to Man a blank slate.
Very much so. Very much so.
I'm coming to pull it out of you. I've got to kind of reach in there and make you go back to these opening moments.
Yeah.
Now, let me ask you though, do you think that looking back, you were better off to come in as a blank slate versus somebody who showed up and was like, oh, I've been trading my own account and I've got all these strategies and da 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 da. I mean, how do you look back on that?
Yeah, I think there's definitely an element to that, to be honest with you, because I kind of built up the fundamentals on the job without anyone telling me this is how the markets work and these are the inefficiencies. I was really very fortunate, and I was able to build models and trading strategies completely fresh with no one telling me this is how things work and look for these factors or look for these signals. And I do think that has some value to it. Yeah. One challenge that we have for people these days is they come in and they kind of come into this very complex edifice. There's all these existing strategies and architecture and technology. It's very difficult to have a kind of basic understanding. So I'm trying to encourage that even for new joiners, because that's what I had. We were building things from scratch, and I came into this thing very fortunately building from the ground up. And the trend following part was relatively established, but the equity part was completely new. That opportunity to look at the full cycle of trading strategies. So how you get the data, where you get the data from, how you clean the data, you turn that into a signal, how you construct the portfolios, how you send the trades. At that time, I was even sending trades manually to the brokers. I had to type in the account code for every single trade and how much and etc. and press enter. So the entire thing was very fresh. I think that was a good experience.
Now, this is jumping ahead a little bit. I'm probably going to take you back to early experiences again, but how does Man approach this issue today? Like, for example, do you still look for blank slates?
We do, to an extent. So what we very much try to do is not hire the exact same type of person with the exact same type of CV or resume.
You want diversity.
We want diversity. Diversity is incredibly important. In the teams that I've worked in over the years, those teams with the most diversity of thought have been the best teams. So I believe in it through experience, and we try to encourage that through the hiring process as well.
So again, like I said, I'm going to take you back to that early period, and I want to keep it at that kind of early aha moments. I can remember seeing for the first time some trend following strategies in 1994 and knowing who the players were. And I was like, wow, this is just terribly interesting. Over here is Warren Buffett. And then all of a sudden there's this other world over here. And there's all these interesting players that are connected to this world. I mean, the foundations of Man go back to a lot of these connections that I'm talking about. So when you came in, you're a blank slate, you go down the coding path first. And of course, you really did not have the trading experience, just a smart guy coming in. Did you have any kind of moment where you said to yourself, like when you first understood, for example, a trend following strategy, when you first understood it, saw it, got it for the first time, like a feeling of like, wow, that's clever. That's interesting. That seems different than what Wall Street talks about 24/7.
Definitely. It sounds like for you, there was a eureka moment. And for me, it was much more of a gradual appreciation, I would say. I knew about the trend following strategies. I learned about them very early on, and I learned about how they worked. But it takes time to really appreciate them. For me, how they react in stress environments in particular leads you to believe not just that that is a good way of trading, but also that markets themselves are inefficient. As I said at the beginning, I walked into this place, when I looked at all of it, I thought, this is not going to last. There's all these people using these computer programs, and any inefficiency in the markets is going to disappear. That was my viewpoint, and it took time for that to gradually dissipate. And the moments that really move you on in terms of, markets are not efficient, they're really not, are those stress conditions in particular. And that was summer of 2007 and then into 2008. During those periods, you're looking at how the trend following systems are reacting and adapting. Those points in particular, you think, well, that system is just so well designed in every aspect, actually, from a practical perspective, in terms of the way that it manages risk, but also the way that it handles margin and all these other kind of practical points that you experience during stress markets. I think once I'd been through 2008, I was definitely a believer at that point. And as time has gone on, I've become more and more passionate, maybe not quite in the ebullient way that you are, Michael, but in the more kind of slightly reticent English way. But I exactly share the passion. It's just been a bit more gradual.
Well, you're showing more pulse right now than the typical British guy. I mean, come on, you're ramping it up, man. I mean, come on. Let me keep it at this, the inefficiency and the idea of stress times. I might even call these events. I could think back when I first started to understand the connection between these stressful times. If I can think back to the 87 stock crash, I can think back to the Barings Bank scandal in the 1995 time period. I can think back to the dot-com implosion. You can think back to the, as you mentioned, the '08 time period, and we can bring it up to 2000 with the COVID happening. How do you, if you've got a room full of people, whether it's investors or new staff, and you want people to understand that when these unexpected events or crisis times or stress times, when these things happen, why is it that the markets move in such a way that it benefits trend following strategies?
COVID is a great example because it's fresh in everyone's memory. What you find during these stress periods is two things happen. First off, risk heightens, volatility goes up, people's level of uncertainty, fear kind of comes into the market, and it manifests itself through uncertainty in pricing. And what does this new worry that has fixated and dominating the markets, how is it going to impact prices? And of course, people don't really know. So volatility increases. And the second thing that tends to happen is that you get this snowball effect. Prices don't lurch down 30% unless there's a very technical reason, but markets tend to snowball. So a small loss leads itself to a larger loss, and that starts expanding. The stress of the market increases and the whole thing increases. And the reason I think, there's no laws like there are in physics, but as you well know, that there are kind of rules of behavior. Behavior compels people to act in a certain direction. And once the market moves in a direction, it compels people to continue to act in that direction. Trend following as a strategy encapsulates both things very, very nicely. It tends to regulate itself in terms of risk. It knows how to size positions in terms of risk. And when risk goes up in the market, you don't need to take as big a position. And it also recognizes this fact that, particularly in more kind of stressed environments, prices have this tendency to go in one direction. In terms of talking to institutional investors, I think you get maybe a couple of different types. You get the ones who they understand trend following, they understand the properties, and they're bought into it. And you get others who perhaps are not quite as familiar and maybe have a little bit more skepticism. For those type of investors, I think what works is just showing the empirics, showing the data, showing the breadth of markets, the time periods when this thing tends to work. As you know, there's a huge amount of evidence to support the theory, and the theory is an intuitive one. I think most people that we talk to, at least, maybe not to the extent we are, but they believe in the power of trend following during stress environments.
Why don't you speak to also that when you have these stress environments, go ahead and elaborate on a big reason why a firm like yours, other firms, other trend following type firms can do well is because of the variety of markets that you are set to trade. Meaning when these stress environments happen, you're looking at a portfolio that a lot of, quote, typical fund managers are not looking at.
Yeah, that is certainly true. One thing that you learn about trend following over the years, it's kind of difficult to make it work well on a single market. And it's not that attractive a strategy actually on a single market. It will occasionally do very, very well, but most of the time you're bleeding money because you're buying high and selling low. And that's kind of the nature of trend. It's a difficult strategy to get your head around if you apply it to a single market. But the important aspect, as you mentioned, is you diversify that approach across different markets. And it's difficult to know when the next big trend is going to come or where it's going to come pressure in one part of the market ecosystem tends to move things in another. And you particularly see that during stress environments. Trend likes uncertainty, as we all know. And so in those kind of environments where certainty on pricing is reduced, you don't know where it's exactly the pressure is going to drive markets. But the more different types of things that you trade, the better chance you have to pick up on the area that sees those strong trends. And that's what makes a good kind of overall diversified portfolio.
Let me let you get baseline philosophical for a moment. Perhaps these are not the institutional clients that you're speaking to that know exactly what you're doing, but we've got a COVID time period unfolding. Okay, this is interesting. Russell and Mann are following a variety of markets. Okay, things start to move. Now, of course, and we'll talk about this a little bit later, but Mann has many types of strategies, not only trend following. When you're looking at that COVID time period, you're tracking these diverse markets. How do you explain to your, I don't know, it could be your friends that don't know about this style of trading, could be family. How do you explain to them that this strategy that Mann is using can work on all of these markets without having fundamental experts in all of them?
That's certainly been a challenge over the years. It's always been a challenge with my kids, especially trying to explain to them what I do. I actually recently found something that resonated with them. They have, over the past couple of months, really got into Pokemon cards. They're trading these Pokemon cards with their friends. What you see is that there are certain Pokemon cards which are maybe a bit rarer, or they've got special numbers or features or whatever, that all the kids suddenly want that Pokemon card. Whereas a couple of weeks ago, they'd have traded that for 2 regular cards. Now the cost has gone up to 3 or 4 regular cards for this Pokemon card. As soon as there's a kind of rush of these things, as soon as there's this sense of, wow, this card is a really valuable one, everyone wants it, then the price of the Pokemon card effectively goes up. Eventually they'll move on to a different one and it'll come down again and that one will go up. That particular feature, which is just a natural, these are obviously kids, 6 and 9, my kids, but this is a kind of natural human behavior in action. I told them that, what do you really do, Daddy? And I said, well, it's like, you know how you trade those Pokemon cards and you try and get the best ones? Well, we do something a little bit similar. So we're not trying to get the best Pokemon card. We're just trying to judge how the value of that Pokemon card might be changing through time. And we do it on lots of different places. And we don't do it on Pokemon cards. Maybe we should, because the prices have gone pretty extreme. But we do it on lots of different markets. And that's how we try to create profits for our investors. And in the long run, tends to work. I do struggle, but I think that Pokemon card analogy has got me a little bit further.
We've already laid down the foundation that the success of this type of strategy goes back a long time. Obviously, your firm goes back a long time. But in the last handful of years before COVID, and I'm not saying this to pick on anybody because I fortunately have had a chance to meet a lot of people and I really enjoy most everyone in the industry. But in the last couple of years before COVID, there were conversations, there were headlines that this style of strategy that we're talking about right now, this, whether you want to call it time series analysis or momentum or trend following, that it was dead. What was going on inside Mann's offices when some of these conversations or headlines were taking place? I'm going to guess, I don't want to speak for you, but I'm going to guess that you did not have these perspectives.
I didn't personally. Once that slow kind of build-up of conviction happened and I'd seen these events unfold over the course of a decade, I've built up very strong conviction levels in this strategy. If you see something that hasn't worked for a couple of years and a new person comes in to the organization, they see something that hasn't worked, it's very difficult for them to have conviction. And of course, institutions as well, investment institutions and allocators, they have that time horizon problem as well, insofar as the teams at these places have turnover and there are new people coming in, and new people will try to understand the strategy and they'll look at the recent performance and they will say, as you said, during some fallow years, does this thing really work? What are we getting from this? So there's a couple of things you kind of asked about our approach internally and what we have done about it. One thing is, as a quant business, we wanted to expand across different asset classes, across different strategies, make sure that we had a diversified offering, because when it comes to institutional business, that helps to kind of smooth things out and helps to make sure that you've got a diverse client base and a diverse fund range. But internally, you do have to kind of convince people a little bit. And my view, for what it's worth, is that those years post the financial crisis, you had a lot of central bank intervention. What that central bank intervention has really done is kind of control price movements to an extent. And central banks were very much in command of the narrative. That led, at least in the most liquid, developed financial markets, to constrain prices. And that's what trend following doesn't like. It doesn't like things to be range bound and constrained. And then you get an event like COVID happening, and all of a sudden the characteristics have changed. And instead of central banks controlling the markets, really it's data and the markets that are controlling central bank action. And that whole dynamic, and we've obviously seen it over the last couple of years, allows for prices to move more. And inflation coming into the market allows for prices to move more. By definition, it's causing prices to move. And the ramifications of that are difficult to predict. But what you get is a system where pressure starts to build up, and that may cause prices to move in one part of the ecosystem and then all of a sudden in another part of the ecosystem. And that is where trend following tends to do well. I think there's kind of two parts to it. There's one part to make sure you're, from our perspective at least, to make sure we're diversified enough to withstand those more fallow periods. And the second part is to retain belief that of the capital that we deploy to trend, we have conviction in it. It may not be a every month or in some places every year type return profile, but in the long run, you definitely want that as part of your portfolio.
Well, that's an interesting way to sum up that thought, because so many investors, whether it's retail or institutional, they have this, I could characterize it many ways. I could say it's a fantasy. I could say it's a dream. I could say it's irrational, but they want consistent performance. They dream that somehow or another, if one decides to invest, if they've made that conviction to invest, they therefore should receive a consistent amount of money each month. If they don't, something's wrong. Now, where this comes from, because, if anyone just wants to look at any of the data over the last couple hundred years, you can see that consistency is not something that's really part of the human condition. But people still want it, don't they?
You're exactly right. You go through a period when, as you say, this is not a return profile that makes positive returns every month, and it doesn't even work every year, even a couple of years. And that kind of profile is a bit more tricky for people who, at the end of every quarter, have to report back to their investment committees, and they say, right, you've got your equities and bonds over here, and then you've got your alternatives part of your portfolio. And what's that? Equities they've made a nice 3% over the last couple of months. What's happened to your alternative portfolio? It's losing money. What are you doing? So they have that kind of challenge, I suppose, of defending allocations to things that are a little less stable. And we kind of need to help them through that process.
When you say a little less stable, though, you're not saying stable in the sense that stable is bad.
Absolutely. When you look at the profile of returns of different trading strategies, you can get some that look very stable most of the time, and then occasionally they have this really nasty left tail and lose lots of money during a stress period. And then you have the opposite, which trend is one of those rare strategies that's the opposite. It doesn't make these steady returns most of the time, but then occasionally it makes these outsized large returns. And that's particularly the case at the individual market level, but also overall as a portfolio, what does that look like? And that is appealing to investors who understand it. What it means is that you can get that really big payoff now and again, and probably at the times when the rest of your portfolio may struggle a bit. And so you get this nice complement. But of course, that's not most of the time. Most of the time, we're not in a stress scenario. Most of the time, we're in kind of normal, stable market conditions. And so therefore, you have this challenge. Once you appreciate that, you understand it, you can see the bigger picture and look at things from a longer term perspective. As I said, for me, time for me to be convinced. But once you're convinced, you really appreciate that this is a diversifying strategy that complements in the right way.
I've really enjoyed over the last bunch of years finding other walks of life that apply a similar thinking. So I can look at the financing of Hollywood films. I can look at some professional blackjack players. I can look at venture capital. I think one of the most interesting ones is when Jeff Bezos talks about his innovation at Amazon. And he says, you hear about the things that have been really successful for us, but you don't see the thousands of things that we tried that didn't work out. And so we try a lot of things that don't work out, and then we get some really massive, big moves, big trends. Do you find that's a fair way? I mean, it's not exactly the same, but a fair way to bring people into the idea of what you do?
Yeah, I think as part of the research process, so maybe moving away from trend for a second and talking about the research process, this is exactly what happens. It's a process in which you have some theories, you have data, you have different techniques, you hopefully have an excellent platform and able to explore these things. But the hit rate, it just isn't that high. And what we tend to do is we'll come up with a theory and turn that theory into a trading strategy. And all of that is based on some data period that's been revealed. And some reviewers will come in and they'll talk about why the strategy works and what could go wrong. And then they'll test it on some other data set that they haven't seen yet. And oftentimes it doesn't work. And I guess that points in the same direction as you're talking about, that you don't really see the things that fail, and there's lots of them. And then hopefully now and again, you stumble upon things that do work and you can scale them up and they can make a real difference. 100% agree with that process of what you see is just some small representation of what we try.
You mentioned about we were talking about the return profile, getting people to see the benefits. For example, let's say someone starts to understand the trend following part of the process that you can give them. When they understand that return profile, and you mentioned, well, somebody's looking at their alternatives and saying, well, hey, what's wrong with the alternatives? Our other stuff is up. I mean, that's the challenge too, is to get people to understand why you actually want those two different profiles. I mean, people don't instinctively understand that you don't get a chance to just all of a sudden decide one day before the big COVID melts that all of a sudden you become a trend follower that day because you had some premonition that now I should be a trend follower. It doesn't really work that way.
No, that's right. And the reality of convincing people is oftentimes they need to see that kind of behavior. So they need to see a March 2020 or a Q4 2018, or you go back, but they see it and they say, well, it's all very well the times when my equity portfolio and everything else is doing well and you're not doing so well, so I don't get it. But then all of a sudden their equity portfolio does badly and you have a diversifying strategy that's making money in those conditions, and then they get it. Then it's like, okay, it's not always the upside. There's a downside as well. And portfolio diversification matters, and it matters particularly in the downside. So for the most part, you kind of need to build up that experience. And those that are able to grasp that before they experience it, all power to them.
I saw recently a Mann paper on potential inflation and trend following working if that type of environment unfolds. Some might argue that it's unfolding right now. You'll have to tell me what your view is. But what you're really doing is you're laying out the scenario of like, okay, we can look to the past and we can see some of these event periods, these environments, these stress environments. We can look to the past. But when you bring up, for example, this white paper on inflation, this Mann paper, it's really getting people to look ahead to the future too. Like, hey, we can keep talking about the past. You probably want to think about getting prepared now, not when it happens.
Absolutely. That is always the big challenge because of the preparation time. It kind of takes time for people to recalibrate and convince themselves that the downside risk and the scenarios that we were contemplating a couple of months ago are moving, and they obviously they can move fairly quickly. When you look across the spectrum of investments, full stop, but investment strategies as well, inflation doesn't always help them. It can be a challenge, not just for buy and hold type investments, but for trading strategies as well. But there are a few that tend to do very well. And as I mentioned earlier, inflation is about prices increase, about price movement. Therefore, as an investor, you need to think about strategies that can benefit from prices moving. And there aren't a huge amount of them that have positive expected return and benefit from prices moving. And trend is one of them. In the paper that some of my colleagues wrote, they suggest other strategies. So trying to diversify across other strategies that are systematic in nature, but benefit from inflationary type environments. The challenge for a lot of investors at this point, and by the way, we've been talking about this now for quite some time. It's not as if it's cropped up in the last few weeks. The challenge is getting people to move, the movement, the kind of inertia. But I do think that there's a recognition now that the real significant portfolio risks, inflation being one of them, the probability of that becoming a genuine portfolio threat has increased tremendously in the last 18 months or so.
Would you care to quantify tremendously?
Well, I think we were looking pre-COVID at inflation being very, very much a kind of left tail, unlikely event at that point in time. It wasn't something on the investment radar. The feeling was that all of the rates across the developed world were very low. There was a supportive stance from central banks, and all of that was entirely possible and driven by the fact that inflation numbers had remained so stubbornly low for so long. That clearly changed. COVID was obviously the catalyst for that. And that means that what was previously a very low probability event, and it wasn't really kind of a major factor influencing decision making, is now a major factor. So it's gone from a very small number to a much bigger number. I'm not suggesting that that number, by the way, is greater than 50%, but it's certainly way bigger than the 1% or whatever it might have been pre-COVID. And therefore, it's now driving people's thought process and decision making.
When you talk about the probability for inflation increasing at Man, how do you look at that? Do you look at that from a fundamental perspective, or are you looking at that from a pure kind of quant data perspective, or both?
Well, look, internal to AHL, the joy actually of working at Man Group today is that we've got people from different divisions and different backgrounds and different approaches. And the discretionary division will think about things in a different way to the systematic division that I work in. We tend to look at things much less as here's a regime and let's put a number on the probability of that regime happening. That isn't really something that we engage in because those numbers are so difficult to quantify. Rather, we will look at, if you see these types of movements in data sets, how do they influence the relatively short-term movements of different markets? So that's more our focus. So I can't really give you a kind of man-wide answer to that, but just to say there are different approaches, put it that way.
Let's keep it at inflation for a moment and get people to understand why, for example, the quant side there at AHL and the trend following approaches speak to commodities during inflationary times.
Yeah, I guess, or if you listen to some of the things that have been written by various of my colleagues, and Campbell Harvey's one of them, I know that you've talked to him before. He's always been a proponent of commodities prices reflecting inflation, and when you get inflationary periods, commodities tend to do well. We've obviously seen that very significantly over the last 12 months or slightly longer, that you've got these initially kind of supply side concerns, and then you've got demand increasing from a low base, and the two parts of that equation lead to price increases, and you've seen that across the board in commodities. Having said that, actually, when we look at inflationary episodes in the past, it's not necessarily commodities that are the thing that moves. But what you do notice during inflationary episodes is things move. Inflation is a measure of price change. And so if inflation is high, prices are moving. And if prices are moving, that means that all of the inputs dictate where that price is for a loaf of bread or a pint of milk or a gallon of petrol or whatever it is. Those prices are moving. And in an environment when prices are moving, strategies that can identify moving prices can trade along with that direction of movement and also exit when that trend finishes. They just tend to do better because the trends exist in the first place. That's the rationale behind it. And that's the reason why we have some conviction in trend during inflationary periods, as we speculated in that paper. But also, I think investors are particularly coming around to that point of view as well.
Let me bring something up that I'm not trying to go down any kind of fundamental path or trying to get your macro analysis. I'm just more curious of any aspect of what I'm about to say that factored into any part of the quant strategies there at AHL. So for example, we have this COVID time period, and then in America, the central banks came in and the federal government came in and basically said to everybody, hey, just stay home. You don't have to work. Everyone's going to get paid. Everyone's going to make $100,000 a year and it's a free lunch. And I'm just kind of giving my rosy view of what happened. And then about a year later, and all of a sudden, everyone's posting on Twitter about the price increases at the grocery store. I think for the average person, they sure look at that and they go, well, there's some kind of a connection there. Is there anything inside your part there at MAN, at AHL? Is there anything that you guys do with that kind of data in any of your analysis?
When you say that kind of data, what kind of data?
We're looking specifically at the changes in policy by the Fed, the United States government sending money to people, all these factors that now in hindsight, you look and you say, well, gosh, if people, this is kind of very fundamental sounding, but this is how many people look at the world, of course. But, okay, all this money goes out to people, businesses are closed, et cetera. And then a year later, we have all this price inflation at the grocery stores. Does any of what I've just described factor into your decision-making versus just sticking with the price data of the markets you're trading?
We do use lots of different data sources, and beyond just price data, and there are, as you know, there's been an explosion in alternative data over the years, and that for sure feeds into some of our strategies and some of our return predictions. I wouldn't classify that as a COVID phenomenon. That's been a direction of travel for several years. Perhaps COVID, because basically you've had this big data break, so many data sets, you've had relatively small movements in data from month to month, and then all of a sudden this huge movement, and then that data starts to recover. It's very well the case that that causes big changes in signals for various strategies, but I couldn't really classify that as a COVID thing in particular. It's more just that COVID has caused this big kind of impact on data.
Let me take it to a big picture issue that we've not really discussed by name or in detail yet, and maybe we need to start at the ground level. But the idea of risk. Many people, and I'm sure I'm one of them, have said that they will view risk as loss. If I've got $1,000 and I lose 500, that was not a good risk necessarily. How does AHL MAN view risk?
You comment a lot about trend and the propensity for prices to continue to move in a certain direction. That tends to be true in the long run, clearly. What's even more true is that risk tends to propagate and it tends to be persistent. And there are different ways of measuring and classifying risk, but I think everyone can probably recognize and identify with the fact that markets at some points in time are way more risky, however you define it, than markets at other points in time. So if we happen to be talking in the middle of March 2020, we would know that we're in the middle of a period that's incredibly risky and there's a huge market movements that are happening. If you said to me at that point, how do you think equities are going to evolve over the next couple of weeks? I would have said, look, I don't know, but what I can tell you is those huge moves of 10% per day that we're seeing, is it likely to go back to 80 basis points a day? No, it's probably going to stay pretty high. It's a feature of markets, as important, in some ways more important than the propagation of prices, or the propensity for risk to persist is a feature of markets. And therefore, it becomes not just how do you control risk and think about the downside. If you manipulate it in the right way, it becomes a source of alpha. And we really integrate risk as much as possible into our trading systems. And we recognize that it's not stable and it changes through time. And if we can do as good a job as possible of quantifying that and reacting to that, then it helps in our trading all over the place. From how do we think about risk? We think about it as completely integral to the way that we trade, as opposed to a layer at the end that ticks a box. It's completely integral to the way that we trade.
For risk to exist like that, to be integral to the way that you trade, that means, I guess by definition, that all these folks out there that want to live under the guise of efficient markets, they're giving you that opportunity in many ways. I mean, many of the markets you guys trade are futures markets. That's still a zero-sum game.
Yeah, the move towards passive and towards buy and hold, and let's try to create some kind of diversified portfolio that roughly achieves return targets, and we don't rebalance too much and we don't trade too much and we just hold this portfolio. We would view that as not quite optimal. And it's not optimal for a couple of reasons. And the reasons are all to do with risk and risk management. The first reason is that you are not as diversified as you could be. If you put that charge to most investors around the world, you say, tell me what's in your portfolio, and you look at their portfolio, you'd say, oh, you've got a hell of a lot of equities in there, and they're pretty much dominated by US equities. And what else do you have? Where are the kind of inflation sensitive assets? How are you thinking about credit and corporate bonds and all these other things? And you could level that accusation and you'd most times be correct. And maybe the defense against that would be, well, that's all very well, you saying that, but it's difficult to invest in all of these different things. And by the way, even if I do invest in all of these different things, it doesn't necessarily improve my return. And I care about my return. It's not just the risk, I care about my return as well. Our kind of counter to that would be, well, if you can really diversify and you can manage your exposures and you can manage your risk, because that becomes a key point when it comes to managing a diversified portfolio, you can probably do a bit better than this buy and hold approach. And that for sure is a philosophy that we've found central to our way of thinking over the years. It's something that enables us to think about controlling left tail, but at the same time being able to deliver returns. And ultimately, that's what investors, sort of the whole investment process is all about.
Let's talk about returns for a moment philosophically. So you and I both know, and we can look, and everyone can look, and we can look at the historical track records of, let's just call it the trend following world, all these different traders that have traded for a very long time, often decades. And we can all go back and we can look at this information, and it's interesting data. We also know that going back in time, there was probably a lot more, let's just call it cowboy trading, traders really shooting for massive returns, let's just say back in the day, so to speak. Now, there's a few of these trend following traders still around where they really kind of go for the gusto. Speak to the way that AHL Man is set up today. If we have, and this is just kind of a hypothetical looking into the future, but if we have one of these inflationary environments that really just takes off, it's like 1970s or something, is there anything in your risk management that would preclude Man from having some of those kind of like old school, very large returns? Meaning if all of a sudden the markets present this opportunity, is there anything in your strategies that would keep you away from those types of very large returns if they happened?
The way that we'd set up portfolios, if you look at the return profile of some strategies versus others, then you're exactly right. And some kind of methods of trading, and you get people who look for those kind of real outsized wins now and again. In order to do that, that means a lot more variability in returns in general. We will set up our strategies to obey risk limits and to have them kind of built into the system, as I said. And what that means is that our exposure at any point in time should be appropriate for the market conditions at that time. Now, that doesn't mean we can't take large outsized positions and have conviction positions. We can, but that's within a spectrum of obeying these rules and these limits to sizing. What that means is the more concentrated your portfolio happens to be, the more likely you are to see these more outsized returns. And as an example, some of our strategies this year that have focused a bit more heavily, for example, on alternative energy markets, have seen really large returns, even though they're run under the same guise and the same risk management framework. They've seen those outsized returns this year because you've seen these really outsized moves. I don't think it precludes us, and there are many examples. At the same time, we, as part of our deal and our understanding with our investors, would say this particular fund or strategy targets a certain amount of volatility. If you want it to target more, there's ways to address that, but it targets a certain amount and the return profile should be in line with that. But that doesn't still preclude you from having years in some spaces like this year that are very much outsized.
One of the precepts I think you guys follow is you'll trade anything that's tradable.
Right.
So we've got a lot of interesting new things on the horizon in the last handful of years that all of us are probably kicking ourselves that we did not buy these things they called Bitcoin back 7 or 8 years ago, right? How does AHL Man look at the crypto space? I do know that I've talked to some traders, some trend following traders that have started to trade things like that. How does Man look at it?
Yeah, we've, for many, many years, actually, dates back to the mid 2000s, we've held the conviction that if you have a trading strategy that tends to work to a reasonable degree, it's a very good policy to run that strategy in as many places as you can. And the challenge then becomes in these different marketplaces where you might not have that much data, or you might have a challenge in how you execute and manage counterparty relationships and all of these kind of practical elements. But the philosophy was the more we can push into those different markets, provided that we can trade them in a way that is fair and transparent and in line with expectations, it's going to be beneficial to our portfolios. That has been an ongoing process. And as you alluded to, the market universe keeps expanding. And one corner of that market universe that has expanded a lot recently and continues to do so is digital currencies and the futures markets. You've got Bitcoin and Ethereum, and there's plenty more in terms of coins that can be traded. And that then becomes just another market for us where we can trade, and we think that that trading process is fair and we can get good execution in place. Then the default would be let's trade.
For those Bitcoin, Ethereum going to the futures markets, was that I'm assuming so, but that was a good marker for you in the sense that once it's a legit futures contract, then okay, we can consider this. Whereas when I first met somebody that was talking about crypto, maybe 2014, he was telling me about hiding pieces of paper under his bed with basically QR codes on it. And I thought, man, it didn't seem interesting to me at all. So I assume you're kind of like the same way I am in the sense that once it hit the futures market, you're like, okay, this is something we can consider. Or did you consider it before that?
No, that was the case. I mean, we knew about it before then, and we looked at what was practically involved, but the futures market came fast enough for that to be a no-brainer that we'd go into the futures market. On a personal level, I'm with you. I wish I had been convinced by that argument in 2014 or 2015. In order for us to trade these things at a reasonable scale, you need to have a sufficiently established marketplace. It doesn't necessarily need to be exchange traded futures. That makes it very easy. It needs to be an established marketplace. We need to have enough counterparties that we can trade with. We need to get comfort that the transaction prices are fair. And that normally takes a little bit of time. And we've had examples, by the way, of markets that we just didn't think were fair. And the price discovery process wasn't one that lent itself to our style of trading. So we exited. But in the most part, most markets, once they become established and you can find enough counterparties to trade with, then they become fair game.
I'll tell you one, just a complete side tangent that I became aware of since I'm here. There are no futures contracts for the rice market in Vietnam. It's just unbelievable numbers of kind of independent farmers, and they've just not done it yet. But with the amount of rice that's produced in a country like this, oh my gosh, if they ever kind of get that structured. I want to open this up to the idea of new strategies. But first, I want to see if I'm establishing the foundation correctly. I think I am. Man, AHL, starting up as a money management firm, their first offering was trend following. You were bringing a trend following product to investors. Is that a fair assessment? That was the first offering, so to speak.
Yeah, that was the initial, when Man bought AHL back in whenever it was, the early 90s. That was the product that was offered, yeah.
As you continue to evolve, it's kind of a curious question. So you've got this source of alpha, you've got this client base. people that like this product, they like these returns. The company has obviously grown and done well over the future, but you're not resting on your laurels. You're constantly, as we've talked about in this conversation, you're testing new ideas, new strategies, etc. How does that unfold? Because it seems like an interesting scenario where you've got this foundation. It's been very successful, this trend following foundation. You have lots of conviction that it's going to continue to be successful into the future, but you are diversifying. I don't know if it's a matter of public record or not, or if you can share it. If you can't, you can tell me to jump in the lake. Where does your source of alpha break down now? So if you've got 100% pie, what percent of the man alpha is trend following today?
I think we disclosed this our last earnings announcement, so it's viewable public information. But roughly speaking, the AHL assets make up very, very roughly about a third of man's total assets, maybe slightly more, but that kind of ballpark. And then within AHL, about a third is trend following, and then 2/3 are other stuff, either multi-strategy, quant, or risk managed strategy. To answer your question, across Man Group, it's about a third of a third, so a ninth, more or less, 10%, let's call it.
Gotcha. Is there a strategy that has become the most dominant strategy at Man? If it's not trend following, I'm just curious, is there a strategy that has become the most successful, most dominant aspect of your business?
Not really. So, I mean, I think trend, it was certainly number one for many, many years. It probably still is in terms of its contribution to Man Group overall, because of the nature when trend tends to be a very directional strategy. And so the P&L kind of tends to be relatively significant as well, compared to, say, a kind of long only equity manager that's benchmark based, where it's much, much smaller. But there are other things that have established themselves over the last 5 or so years. And we've certainly seen a lot of interest in more risk managed type strategies where we're providing some exposure to market returns, but doing it in a slightly more sophisticated way. So that's become another big element of what we do. Amongst all of that is a huge amount of different types of strategy on different asset classes that we build up and build portfolios for clients that are looking for different types of return stream. And what that then necessitates is a research process that is producing sources of alpha in as reliable a way as possible, allocating to those sources of alpha that we continue to have conviction in, deallocating from the ones that we think pass their sell-by date or are unlikely to work in the future. And in all of this, what underpins all of this and maximizes the chances of us being successful is that we have a platform, an execution infrastructure that maximizes the extraction of returns and minimizes the cost. And so a big part of what we do and a big part of our focus is on exactly that bit of kind of efficiency of alpha extraction.
How much time does Man spend trying to, I don't know if I'm going to say this so sophisticated, to punch holes in strategies? Like, for example, are you constantly trying to tweak or improve a trend following strategy? Or do you feel like you've got something that's robust enough and it can't really be improved? We got to just wait for what the market's going to give us, and we're ready to go when the markets give us what they decide to give us. How do you approach trying to stress test strategies or prove them wrong, or how do you go about that?
One thing that's hugely important for us in the process of managing all of these different strategies is that we are able to look at the impact of what we've done. Because one potential flaw in the approach to researching systematic strategies is people tend to rely quite heavily on back tests and simulations. And if the back test said it improved things, then okay, we can change the strategy and we've improved it. Obviously, the reality is that you haven't improved the strategy until you've tested in live trading that version of the strategy against your original one. We've been doing this for many years now, and we've built up a good database of information that tells us where is the most fruitful, on average, pursuits. Is it tweaking the nature of a trend following signal, or is it looking at adding a new market or adding a completely new data source or a new signal altogether. What we tend to find is you need to be a bit careful about that tweaking bit. Systems should evolve and we should come up with better ways to do things. But often those better ways to do things involve new data sets or making a step change in the way that we might think about measuring risk or measuring a trend or reacting to market movements. It's unlikely to be, let's tweak a parameter in the model. The key to all of this is that we're measuring things in live trading, and that gives us a good handle on where have we added value to our clients, where have we not, how does that compare to our expectations before we did that. For each individual change, that may be a challenge, but by the time you do it across hundreds or thousands of these things, then you can really build up some good solid data that helps you to decide where to deploy your efforts.
Why does this keep you so excited? Why are you energized to do this particular type of work? Does it go back to my opening kind of addressing your background in the sense coming from this physics background? That's a different way of thinking. That's not like the guy that shows up and says, I'm at Boiler Room and I want to be a broker and I want to sell people. Is it that physics background, that kind of pondering, deliberating type background that keeps you excited to be in this space for so many decades?
There's definitely a part of it that is curiosity driven, knowing that in this space, you're never at perfect. You've never got there. And you can always do things to improve outcomes, improve your models. And the landscape itself is not static either. And so compared to when I started 20 years ago, the idea of having tick data to run a daily trading system or a weekly trading system was very, very difficult to reconcile. And partly because if you wanted to use the tick data, you had to manually load these CDs one after another to get the data and then start to do your research. It took so long that became completely impractical. And obviously, data has moved on tremendously. What we can do in execution has moved on tremendously. The market sets that we can trade continue to evolve. And therefore, the opportunity set keeps evolving. The kind of what keeps you going bit is that for sure, what you don't want to do is sit back on, here's your trading system. It'll probably work eventually. And we don't really need to do anything, because that's, number one, it's completely demotivating to all of your staff. But number two, it doesn't work. We've seen that in the course of our history, that if you become too reliant upon one thing and it goes through a few years of not working, you've got a real structural problem for your business. And alpha erodes through time. What were inefficiencies disappear. And so the value, what really motivates me is the complete conviction that the value of the research process is really important, and you need to keep innovating. You need to keep coming up with ideas, particularly if you're managing capital at scale, in order to provide the best returns that you can. So it's this challenge bit. It's a constant challenge, and that's what keeps me going.
I do find it so interesting, and you can tell me if things are collegial. I think they are, with Man acquiring AHL back in the day, and then the H and the L going off to eventually start new firms. A pretty kind of collegial type world there in the UK, where a lot of people that know each other, I assume it must be a pretty collegial group. You guys all know each other, right? It's a small universe, a small world, so to speak, huh?
It is, in the sense that the UK-based trend-following community, I suppose, has evolved from AHL mainly. It's evolved in different directions. And as we've seen over the past few years, it's not just those famous names that you'll know, but it's also kind of names from within the company and within the industry that go off in different directions. And you definitely tend to find that there's some commonality in people's origins, I suppose, and the heritage and the way that they therefore think, which from a knowing people perspective and from a network perspective is fine. But I suppose from a edge perspective, and bear in mind, this is always a slight element of competition here, and always a slight element of how you're providing the best strategy that you possibly can. There's therefore the challenge to figure out ways to incorporate a lot of diversity of thoughts, to provide a platform in which innovation can happen as efficiently as possible. And for me, providing an environment in which individuals feel that they've got freedom, that they're really in an environment that supports innovation, but they also have some accountability, and they understand that all of these things can be measured, and that enables us to credit where we think good work's happening and vice versa. And so if we get that environment correct for people and we get the technology and the platform bit correct, then we should have a good chance of improving systems, adding alpha, and being competitive. On the collegiate part, yeah, it exists, but we keep obviously trying to be as independent as possible. And I think people can judge that for themselves, but hopefully that's been the case over the years.
Yeah, it's just a cool origin story. It would probably make a fabulous book. But the thing is as success starts to happen in the modern age, I think success likes to stay more quiet. Whereas before, back in the day, people talked more. These days, people talk less. But really cool stuff, Russell. I appreciate you taking some time today and walking me through my random, maybe unconnected thoughts to kind of lead you down the path, so to speak. I love the way that you got started, that you just really had no earthly idea what you were walking into. I think that's awesome. It's an awesome way to be. For me, somebody that has spoken with so many different players in this industry, I'm not surprised by anybody's unique story anymore, because it seems like everyone's got a unique story. There's very little like, I came into this quant systematic trend world the exact same way. I just find very little of that. Everyone seems to find their way there. And then when they get a smell of what it is, if it fits their personality, they're kind of like, okay, wow, I like this from a trading perspective. I like this from a lifestyle perspective. I like this from a life philosophy perspective. This fits me well. And you seem like another one of these people that it fits well.
I think that's the case, but it also points to the reality of dealing with the future, which is what we do as investment professionals. It's inherently uncertain, and that kind of randomness got me into my job, but it also kind of constantly keeps me on my toes, thinking about how you deal with whatever challenge comes up next. I suppose in that sense, it's been an evolution in terms of facing uncertainty and kind of reacting to it through time.
You could have just chosen buy and hold, and then you just sit there for 10 years, and then you lose 50% in 2 years or something, and then all of your peers lose 50%, so it's all a relative loss, so no one feels any pain. I don't know. Once it gets in your system, though, that dealing with uncertainty and dealing with randomness, you're an old pro at it by now.
Yeah, I think so. I had this story about COVID in February 2020, and that period when the markets really started to get fearful. For a long time, the markets were completely ignoring the fact that there was this virus that was spreading, and he thought for a time it was just a China problem, despite the fact that there were cases kind of cropping up all over the world. As far as the markets were concerned, it was a China problem. And then you saw this big cluster of cases in Italy. I think it was Sunday, the 23rd of Feb. All of a sudden, it became a global problem. And you had this kind of constant negative news train that was so bad, so terrifying. And I went skiing on the Friday of that week. That week, markets were down 10%, and all of these fears about COVID and what's going to happen and how's the world going to react were just kind of escalating at that point. And I went away on this ski trip. I definitely thought to myself at that time, I am so glad that I am running these systematic strategies that were exactly built to react to uncertainty and to adjust positions accordingly. And I felt way calmer with that approach. And I took the plane back, and I remember just this atmosphere of people being so fearful. I mean, what are we going back to? Is this the last ski trip we're going to be able to take for years? What kind of living through that episode just re-emphasize yet again. And if you've been in this for 20 years or 30 years or longer, you'll have been through certain episodes, just re-emphasize that when the market gets really stressful like that, it's very good to have a system in place.
Yes, your peers that would have been using other strategies that did not have the benefits of the strategy that you employ, I'm sure there must have been a feeling of I'm naked almost, in the sense that I'm exposed, and there must be a feeling of like just things flashing before one's eyes. It really seems like now that we're in this age of being able to quantify price, to follow price, to use tech to manage things, it does seem terribly inferior that so many, let's just call them retirement assets or whatnot, are still lodged in strategies that don't take into account any of the mindset that you've described in this conversation.
I agree with that. I had lots of calls from people during that time saying, what should I do? I've got my investment. I don't know what to do. And I don't know what's going to happen to them. And should I go into cash or what should I do? I obviously very much refrain from giving investment advice to friends. But what you realize is, look, you cannot be there trying to make these decisions with all of this stuff moving around. And for you to just make one decision, one simple one, should I kind of convert all my savings into cash and at what point? And is the market distressed or is it not distressed? It's so difficult to do. You're a passionate believer in this, and so am I. I think it can benefit a lot more people just having a bit more of a systematic approach. And that's true most of the time, but it's really particularly true when you most need it, which is during those times that the world's just going crazy. And we've seen it a couple of times over the last few decades, and there will be another one and it will look totally different and the catalyst will be different. But the kind of emotional bit, dealing with portfolios and trading and management of risk, that will be very similar because, as we know, that's what happens and that's how markets react.
I have to end it with this thought, but you brought up the friends that might be coming to you and they want insights during a rocky period. And I can just imagine what's going on in your mind. I mean, look, I'm not working for a fund, so I don't have to necessarily worry about too much. But I'm still to the point where it's like if somebody's asking at that moment in time, and this happens, it happens to me, especially from the ladies that I know, they all reach out right when this stuff is happening. What do I do now? What do I do now? And there's no answer, because if they were to get inside your mind, they would realize it's too late. When the proverbial you know what is hitting the fan, it's a little too late to be asking for what to do. And I can only imagine what's going on in your mind when people ask you, because there's no way that you can impart all that you know about the markets, investing and whatnot in that moment in time when a friend who's not knowledgeable about what you know wants it at that moment in time because they're afraid and scared. But they look at you and they say, well, he works for a fund. He could help me right now. Tell me what to do. What do I do right now? And it's very difficult time when that happens, isn't it?
It is. And you kind of feel like you might be letting them down a little bit. But ultimately, that's the reality of it. If you've got this very static kind of retirement portfolio, you're not going to be in a position to react and do things. And if you try to, you're liable to make the wrong decision. My advice to people during those kind of things, in all honesty, is look, if you're not able to react quickly and you're not able to trade these things very quickly, which you're not typically, then you should just be a bit more calm about the whole thing and take a longer term view. But I agree, it's one of the challenges of our profession. The other challenge, by the way, is explaining to people what you do. I hope that Pokemon kind of card trading analogy might have helped a little bit, but that seems to have resonated with my kids at the very least.
Yeah, it is always tricky, right? I don't think I've ever convinced my father about what I'm up to. I don't think he's completely like, what is that? Hey, Russell, where can we send people? Man is easy enough to find. I believe you guys have got the domain, right? man.com.
That's right. Yeah, man.com. You can go there. It's obviously a very simple to remember website, and that contains all of the information about the various bits and pieces within Man Group.
I mentioned the inflation paper. Can the average person find some papers on your site, or you guys got it all locked down? What's going on over there?
They should be able to find them. There's something called Man Institute, which you'll be able to click through from man.com. And that contains a lot of thought pieces and papers that will hopefully be useful to some people. You mentioned the one on inflation. We've got lots about risk management, etc. But that's all available stuff. So anyone can go on the website and click through and read some of those articles.
I hope I kept you energized for the duration.
Well, that was great, Michael. I really appreciate it.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.